Hello, I'm Bernard Hickey from interest.co.nz and welcome to a double shot interview, another in our series of interviews with chief executives and ministers talking about the New Zealand economy, banking, financial issues. And today I'm here in Wellington with the National Australia Bank Chief Executive Cameron Clyne. He has a New Zealand connection though too, apart from the fact National Australia Bank owns the BNZ. He was the Chief Executive of the BNZ up until the middle of 2008 when he got the top job at the National Australia Bank in Melbourne. Cameron, thank you very much for doing the interview. That period in the middle of 2008 when you got the top job at NAB, it must have been an interesting one, those first 6 months or so as the global financial crisis broke over the banking system.
Look, it was an extraordinary period, and I guess there's been quite a lot of reflection on that in recent days. Some books have come out in Australia sort of recounting some of the turbulent time. Look, it was very interesting because really, you know, we were at the bottom of the world in many respects, and we're just looking at what was happening in markets in Europe and the US. And you know, I think now we're in a period of relative calm. Having said that, there's a number of issues obviously going on around the world, but I don't think people really realise just how close we came to a very catastrophic outcome.
Give us a sense from inside the system on how much sort of pain and worry there was there in those days in September.
Oh, look, there was extraordinary worry. I think when Lehman collapsed, the concern was, is this the precedent? You know, I mean, basically there'd been a bailout of Bear Stearns, or a forced sale of Bear Stearns back in March 2008. When Lehman collapsed, the view was, is this really going to be a precedent? We then quickly had AIG following, and AIG was much more of a concern because its extensive insurance links around the world and the fact that so many people and businesses rely on insurance, that if that collapsed, that was going to be catastrophic. And I think what we saw was funding becoming very difficult. You know, we were going to the market every night. You know, we previously sort of secured, you know, this is a AA rated bank as well. We'd previously secured short-term funding quite comfortably, perhaps, you know, on a usual 90-day basis. You know, we were going to the markets every night, and the cost was getting higher every night because people were basically saying, you know, I can trust you'll be here tomorrow, but maybe not the next day. And, you know, when you're trying to run a business, and I guess, you know, we're obviously a very large bank, but in a global context, we're quite small, you feel a little bit helpless because at the end of the day, you can do all you can to protect your institution, but you're going to be subjected to much bigger forces.
And now we've seen some stability, but what's your view on the funding situation and the costs for the big Australian banks who obviously own our big banks?
Yeah, well, I think the funding costs at the moment are going back up. There's definitely a concern in Europe at the moment. I think people are reasonably confident that Europe will come through it. In the sense that, I mean, there's been some dire predictions of, you know, the end of the European Union or the end of the euro. I mean, certainly we're not of that view, but we're optimistic Europe will come through it. But Europe's probably looking at an extended period of sub-trend growth as it puts in place sort of budget restraints, fiscal austerity packages and other things. So I think when you're in a period of uncertainty until I guess there's been, you know, the full outlining of those packages and the full disclosure of perhaps where some of the sovereign debt concerns are, you always tend to see spreads go out, and that's happened at the moment. Spreads have gone out significantly.
And what sort of extra funding costs is National Australia Bank seeing, not just in Australia but in New Zealand as well?
Well, at the moment we are seeing, you know, I guess you're sort of seeing spreads going out probably for 3-year money, you know, in the order of probably having gone out from sort of 100 basis points over to perhaps even close to 200 in some cases. The issue, of course, is how long that lasts for. I mean, obviously what we're doing is, you know, rolling funding all the time, so you tend to look at what the average cost of the book is. Now, if this is a relatively short-term phenomenon and, you know, the rescue packages are put in place, the transparency is evident, then spreads will come back in. So therefore it probably won't have a significant effect on, you know, the average cost. But if it lasts for a significant period of time, as it did back in 2008, that does tend to impact your overall cost of your funding book, and then that's going to have an impact on cost of credit here in New Zealand.
And what does that mean for retail interest rates, mortgage rates and term deposit rates, both in Australia and New Zealand?
Well, if funding stays high, if spreads stay high, then obviously that's going to have an impact on cost. I guess you've got to marry that now that both Australia and New Zealand are moving to a rising interest rate environment anyway, which is driven more by some of their monetary policy objectives. So you'd probably see the combination of that with a higher funding cost, probably saying if those funding costs, and the big caveat here is if funding costs remain elevated for a period, then you're likely to see higher interest rates. But if this is more of a short-term concern, then it may not have quite the impact.
What's your view? Is it long-term? Is it short-term? Is it something that's going to last years and years?
I think actually my view is that what we're in for is a period of volatility. So I think what you'll find is that the global financial crisis was such a profound event that what you've actually seen is, I think, a strong desire that people want to be optimistic, they want to feel more confident, but at any sign of any particular concern, whether it be Greek debt or a particular institution that may be troubled, people then become very uncertain again. And I think what we're in for, maybe for the next 5 years, is volatility, that people will be concerned and therefore you'll see spreads go out and those periods of concern then retreat. So what we had pre the GFC was remarkable stability in funding costs. I mean, you just basically were seeing fairly small movements and therefore you had a fairly predictable interest rate outlook, absent what monetary policy objectives might have been. I think we're moving into a period of volatility.
Now, looking at the regulatory scene for banking globally, but also in Australia and New Zealand, do you think there's the risk or the likelihood that regulators will force banks to reduce their leverage and to put more high-quality capital aside that would affect the way banks operate? What are you seeing there?
Yeah, well, there's really, I think, and obviously it's topical because we're coming up to the G20 meeting in Canada over the weekend. Now, that's, I guess, a preliminary step. We think the real regulatory framework will probably emerge from the G20 in Korea in November. So this is a stepping stone, but it's an important thing because there'll be obviously some guidelines that will come out. This is a big concern for potential funding costs because there's really three things the regulators are focused on. The first is capital, as you say. The second is liquidity and how much really banks hold in liquid assets to buffer them through a crisis. And the third is the stability of their funding. Now, if I look at capital in the first instance, that's not a huge concern for the Australian and New Zealand banks. We are very well capitalised by global standards, and therefore I think any regulatory moves there will probably be bringing other banks up to the standard that Australian and New Zealand banks are already at. The liquidity is more of a concern. I mean, what's become quite clear is that banks probably do need to hold more liquid assets to buffer them through a funding crisis. The issue for Australia and New Zealand is that the traditional, or what the regulators are looking for in some markets, is traditional holding of government securities. Now, we just don't have enough government debt in Australia and New Zealand for us to hold that. So I think we're going to need some flexibility to look at other asset classes.
What type of assets do you think?
Well, maybe residential mortgages, for example, and we've obviously got a strong prime mortgage market in Australia and New Zealand, so it may be parcelling up those mortgages and making them available for repo to the central bank as being, effective liquid assets. We just don't have government debt. And other jurisdictions are issuing a lot of government debt, so it's easier for them to ask their banks to hold that debt as liquid assets. So I think we just got to watch that one closely. The one that's probably of most concern is this, what they're calling the net stable funding ratio. Now, Australian and New Zealand banks are both reliant on offshore capital. We simply don't save enough to deal with the spending that we want. Now, the banks traditionally fund themselves from customer deposits locally. Then local term funding, both short and long term, and then offshore funding, short and long term. There's some proposals coming out of Basel III and the financial regulatory forums that suggest that the funding ratio should, in an extreme sense, be 100%, i.e. it's 100% of customer deposits plus term funding. Term funding, by definition, being seen as more stable, and not subject to the vagaries of the short-term markets.
And how would that compare with what we've got at the moment?
Well, it'd vary by institutions, but we've certainly done some modelling, as most banks around the world, because I guess we're all contributing to the regulatory debate. If we went to that ratio, it would have a very profound impact on the availability and cost of capital or cost of credit. Now, I think what we're